Are you scared of stock market? You are not alone. But here is the good news. Fear usually comes from not understanding how it works. In this video, I will show you how not to be afraid of the market, how to invest smartly using ETFs, and how even the worst crashes eventually turn into gains. Let's make money without the stress.
Stock market fear is normal. Most of it comes from two places. Number one, seeing dramatic headlines. Number two, thinking you have to pick the right stock to succeed. Here is the truth. You don't need a crystal ball, you just need a strategy and the right mindset. So, what's the worst that can happen? Let's look at history. This history applies only to S&P 500 ETF, not an individual stock. See the pattern? Every crash feels scary in the moment, but the market always bounces back. Time is your biggest asset. Why ETFs are safer than stock picking? Still nervous? You don't have to gamble on individual stocks or chase risky penny stocks. That's where ETFs come in. ETFs, exchange traded funds, or like basket of stocks. When you buy an ETF, you are investing in hundreds of companies at once. Less risk, instant diversification, low cost, great for beginners. Instead of guessing which company will grow, just ride the market itself. Index ETFs like S&P 500 have returned around 10% per year long term. Why S&P 500 ETF swing traders shouldn't panic? Now let's talk to the swing traders out there. If you trade the S&P 500 ETF like SPY or VOO, you might think short-term dips are scary, but here's why you don't need to panic. S&P 500 has one powerful historic trait. It always comes back. Sure, the market can drop sharply, but over and over again it recovers. That's because the S&P 500 tracks 500 of the strongest companies in the US economy. Even if a few companies struggle, the rest carry the index forward. When you swing trade something like SPY, you are trading a broad slice of the US economy, not betting on one risky company. That means fewer surprises, more reliability, and a chart that trends upward over time, even with bumps along the way. If you see here, if you had traded on BlackBerry, which is an individual stock, it never recovered. The trend is your friend, especially with the S&P 500. So, even if you are holding for days or weeks, historical momentum is on your side. Just use smart risk management. Watch technical trends and remember the S&P 500 has recovered every time. How to invest without fear? Here is how to protect your money and sleep better at night. Don't invest money you will need in the short term. Use ETFs instead of individual or penny stocks. Stick to a long term plan, 5 to 10 years. Invest regularly, like every month. Don't panic and sell when things dip. Dips are temporary. This is for investors. Now let's come to swing traders. How to swing trade ETFs without fear? Okay, so you know the S&P 500 ETF is historically reliable, but how do you actually swing trade it without freaking out every time the price moves? Here is a simple swing trading game plan that removes the fear and keeps you focused. Step 1. Know the trend. Use daily or 4-hour charts to spot the direction. If the S&P 500 is above the 50-day moving average and forming higher highs and higher lows, the trend is your friend and fear fades. Step 2. Use support and resistance. Mark out key levels where the ETF tends to bounce, support, or stall, resistance. These areas help guide your entry and exit points so you're not guessing. Step 3. Manage your risk. Only risk 1 to 2% of your total account per trade. Always use a stop loss. That way, even if you're wrong, the damage is limited and you stay in the game. Step 4. Set realistic profit targets. You're not aiming to double your money overnight. Swing trading is about steady wins. Go for 2% to 5% gains, especially in trending markets. Step 5. Keep a trade journal. Write down why you entered the trade, where you set your stop and target, and what the outcome was. Over time, this builds confidence and helps eliminate emotional decisions. You don't need to predict the future or time the exact bottom. Just trade with a plan, manage your risk, and trust the process. The ETF, especially the S&P 500, is historically on your side. Age-based investing. The closer you are to retirement, the less risk you should take. Here is a simple rule. 100 minus your age equal to percentage in stocks. Example, if you're age 30, 70% should be in stocks, 30% should be in bonds. Age 60, 40% should be in stocks, 60% in bonds. This helps you grow when you are young and protect when you are older. You can also use target date ETFs. They automatically shift your portfolio towards safety as you age. Set it and forget it.
Let's recap. The market has always recovered. ETFs give you instant diversification and you can adjust your risk based on your age. So don't be afraid of the market. Be informed, be patient, and see the magic happen. If this helped ease your fears, give this video a like and subscribe for more beginner-friendly investing tips. And tell me in the comments what's your biggest fear about investing. I'll reply you with practical advice.